Let's talk about dividend investing and take a look at the performance of investing into a high yield fund versus simply investing into the S&P 500. I know dividend investing is really appealing to a lot of investors because of the concept of passive income, right? Investing into a high yield stock or a high yield fund that ultimately pays you a dividend which generates cash flow back into your pocket. But as we're going to see, that concept is a little flawed. So let's start off here by looking at the ProShares S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL. I love that ticker symbol NOBL, Noble. This dividend ETF generates an annual dividend yield of 2.37%. So that means on an annual basis, it pays out a dividend of about 2.37%, your value of the fund. So if you have $10,000 in the fund annually, it will pay out about $237. Right? Now that doesn't sound like much, only 2.37%. And truthfully, I don't think that is very much, but let's give it some context. Let's give it a basis. If we compare it to the S&P 500 here, and I've got an S&P 500 tracker ETF, SPY, pulled up, the annual dividend yield of the S&P 500 is 1.62%. So the annual yield of NOBL, the Dividend Aristocrats ETF, is about 50% higher than that of just the S&P 500. Now let's look at these two on a total return basis, because that's what we're going for here. So if we come back to the main page on Morningstar and go to the interactive chart, it's going to load an interactive chart that's going to show the value of $10,000 invested in this fund. We'll set it to max. And here we can see that if we had invested $10,000 in NOBL on what would effectively be 11/1/2014, on a total return basis, meaning that all dividends, distributions, and capital gains get reinvested in the fund, it would have grown 159% to a total value of $25,996. Not too shabby. Now let's put the S&P 500 on here. We will use Vanguard's S&P 500 mutual fund. And we can see that $10,000 invested in the S&P 500, again on a total return basis, would have grown to $29,512. That's growth of 195% over this period of time. Now, keep in mind here, this means that you are reinvesting all dividends. And some of you guys are probably going to say, well, that means that I couldn't have gotten the dividends back into my pocket and used that for spending money. No, that's right, you couldn't. But what you could have done here is sold a portion of your portfolio. You could have sold, say, 2 or 3%, maybe more of your portfolio, and ultimately done better if you were just investing in the S&P 500. Right? Because the S&P 500 had a higher total return, you could have effectively made your own dividend just by selling a little bit of your portfolio each year to, generate the cash flow to yourself, and you would have done better than had you just, cashed out your dividends from a high yield fund like NOBL. Now you might be wondering, why is this? Why does this happen? Okay. I thought, high yield is supposed to be paying me money here. But it's not, right? You're going to do better if you just invest in the S&P 500, which is not, generating a high yield, but it's growing and generate your own dividend. Why is this the case? Well, this happens because a lot of high yielding companies, the ones that are paying dividends, they're paying dividends because they don't have much room to grow. They don't either, I don't want to say they don't have a plan for growth. They probably have a great plan for growth with a great 100-page white paper behind it. But simply they cannot reinvest their cash into anything. They don't have anything to do. They don't have anything that they can use their cash for other than paying dividends. So simply put, they're paying dividends, but they are not growing. A great example of this in a company that usually comes up in these high yield screens is Verizon. Verizon has an annual dividend yield of 5.02%, right? That's really hot. And they've been paying a high dividend yield for a long, long time. But when we look at their chart of stock performance over the last 5 years, we can see it really hasn't gone anywhere. Over the last 5 years, the S&P 500 has probably doubled. Let's just set this on here. Yeah, the S&P 500 is basically about doubled on a total return basis. literally 106% return or gain. I shouldn't say it's a return, that's a gain. Whereas Verizon as a stock has maybe gone up a little over 10%, maybe probably about 12 to 13% is how much, Verizon has gone up. So Verizon as a company here is paying out this high dividend yield. They're paying this high dividend of 5.02% annually, but the stock itself is not growing. And I don't know, the details of Verizon and what they're doing for growth, but ultimately they're paying that cash flow back out because there's no better alternative of things that they can do for that cash flow or with that cash flow. They can't invest it in anything and make their business grow. So ultimately, that is where, these high yield type of funds really underperform, or what causes them to really underperform. And I shouldn't say it causes them, but that is one of the factors that causes them to underperform. They are simply paying out their cash because they have nowhere else to invest it in growth. Let's take a look at some others here. I know JEPI, which is JP Morgan's equity premium ETF, they pay out a higher yield than the dividend aristocrats. Let's just pop that in here to Yahoo Finance since I've got that open. And we'll see their annual yield in here. I am not seeing it here. Let me just Google it. And here we go from ETFDB. 7.95% annually is what this JP Morgan premium equity or equity premium they call it pays out. But let's look at its performance since it's been around, and that is not a very long time. And here we can see it's paying out a higher dividend than NOBL, but it is also underperforming NOBL. So over this time period that JEPI has been around, going back to about July 2020, we can see the S&P 500 has performed the best. Then NOBL, which pays out a 2.37% dividend annually, or about that, came in at second highest with a 36% growth since then on the investment of $10,000. And then JEPI at 31.62. So it's growing a little bit, but it's not growing as much because it's paying out this dividend. Again, this chart assumes that dividend is being reinvested into the fund. Over this time period, you would have been better off to just make your own dividend from the S&P 500. Before we sign off on this here, there is one other thing I want to look at, and let's just look at this over a longer period of time, because both of these examples with NOBL and JEPI are over a shorter period of time. So let me pull up the Vanguard's high yield mutual fund, and we'll just compare that to the S&P 500. It's ticker symbol VHYAX. And let's just see what its annual yield is. I don't know that off the top of my head. I would expect it to be similar to that of the Dividend Aristocrats. Dividend yield 3.07. So not shabby at all there. And we'll put that on the chart. And we'll go back to the beginning. And this one's going to go back quite a bit further than anything we have looked at so far. We'll set it to the max. And this one goes back to... what is this? Looks like 05-ish. And then we'll put S&P 500 on here. So basically it was performing about the same as the S&P 500. And then in the last couple of years, the S&P 500 started rip-roaring up. One thing to point out though with these dividend ETFs is fundamentally the dividend companies are at a better valuation. This is a more value-aligned portfolio. So I think what we'll see here is if we go to the last 3 months, the dividend ETF is performing slightly better in this time where we've kind of had the growth stocks coming down. But again, over a longer period of time, generally speaking, the S&P 500 outperforms it. So guys, that is a wrap on this video to really kind of highlight the flaw and misconception behind dividend and high yield investing. If there's any details you guys feel like I missed out on, let me know in the comments below. Hope you found this helpful and insightful. I'm signing off on this one, guys.